So I was explaining that the financial services into bonds, essentially investment into bonds or the stock markets are fairly low, and it is only catching up in maybe last 2 to 3 years in a massive way. And mind you, India has got one of the best regulatory systems in place because you have RBI, which is perhaps the most conservative, federal bank across the globe, and SEBI has established its mark with kind of a repute that it is a kind of regulator which is very keen to embrace technology. Just to give you an example, we have in India electronic trading system launched way back in early 2000s. That doesn't even exist in a full-fledged manner even in the United States. There, even today, you have paper being floated across the exchanges for settling the trades. That's not case in India. Every trade in India is through electronic means. So there are maybe 3 or 4 broad asset classes. Each asset class has its own merit and demerits. For example, real estate, which is the most favorite asset class by far, while it gives you a comfort of holding the asset, seeing it on a daily basis, possessing it on a daily basis, but its pricing is not transparent. Unless the demand supply is right, it tends to be illiquid, and the transaction costs are significantly higher. Its pricing is seldom influenced by the localized business dynamics of demand, supply, and so on and so forth. Gold, on the other hand, acts as a hedge versus inflation in long run, but that's all. Bonds give you stable earning stream, and it's good for investors who've got low risk profile. Equities, on the other hand, are the most liquid, and returns of equities in long run are definitely correlated to the underlying earnings growth of that company, of that sector, of that corporation, and so on and so forth. So to me, one can't rely entirely on either of these asset classes overtly, and there should be a balanced portfolio to make money in long run. Now, as a rule of thumb, one can certainly invest that proportion of your money in equities, which is equal to 100 minus your current age. I mean, for example, Milind, who's like 25, can invest 75% of his assets in equity. Milind, right? You're 25.
He's smiling.
Absolutely. So now Milind can spend as high as 75% of his cash flow in equities, considering the fact that initially his ability to take risk is significantly higher, and the risk-taking ability kind of turns down as you grow up in the age. Now, Indian equities, it's extremely curious case. Now, my profession is such that I end up having discussions with a lot of senior bureaucrats in India, a lot of judges, and over a period of time, I've realized that expectation of Indian citizens that we could have utopian reforms is extremely futile. In fact, our system is such that while India can aspire for utopian reforms, it can rarely come through. But at the same time, systemic collapse is also not possible because of strong, solid bureaucracy. So that means you ought to buy into India when the pessimism is at its peak, and kind of exit India in perhaps in any asset class when the optimism is at its peak. So just to give you an example, in 2012-13, commodities were kind of, crude was almost in triple digits. INR was depreciating. You had, current account deficit, which was kind of, gathering day by day. You had scams, and there was very little faith in political system. There was hardly any confidence among domestic investors, leave aside the corporates. But that was a time when, if you look back, in last 5 years, we have had almost $450 billion of, inflows in equities. Since then, the Nifty has given 250% returns or compounded annual returns of more than 21%. Its PE ratio was 14. Is trading at almost 24 times. And mind you, this is at a time when commodities are no longer cheap, interest rates are unlikely to sustain low, government finances are again deteriorating, and as I said, the valuations are no longer cheap. So if you, the reason why I took you through these two themes was this was the best time perhaps for anyone to come and invest in India, because India would never collapse. And essentially, this would give you perhaps the most favorable risk reward. And circa 2018, when essentially you look at a stable government, relatively stable INR, and a massive inflow saying that, boss, India is like, the best country to invest. So the risk reward no longer is favorable, especially given the fact that valuations are damn expensive. So does it mean that, India's story is over? Should one lock, stock, barrel sell India and go back in every asset class? Well, to me, answer is twofold. First, India is extremely stock specific or sector specific now. And I can give you several examples. Right from early 90s when Infosys got listed until, early 2000, maybe 13, 14, Infi has given close to 25% compounded annual growth rate of returns. And it has outperformed the benchmark Nifty by a wide margin. Same has been case with, stocks like HDFC Bank, or for that matter, selectively even Reliance at times. So the point I'm trying to put forth is India is a very stock specific market. One cannot take a top down or a macro approach or a blanket approach while investing into India. There are sectors such as automobiles, BFSI, consumption, energy, which have hardly anything got to do with, the center. Whether it will be Raga or Narendra Modi or Sonia Gandhi or anyone else, these sectors will continue to do well, regardless of government policies, because of the demographics that we have. I mean, for example, good roads in India, which are being built every now and then, paves way for significant penetration of automobiles in India. Better technologies or investment in telecom infrastructure, which is kind of, government agnostic, definitely is a precursor for strong BFSI or essentially the strong banking network in India. If economy does well, you have a lot of free cash, the aspiration levels have gone up. I mean, for example, Hindustan Lever earlier didn't sell Magnum ice creams in India, which are typically 150 rupees for 100 grams of candy. Today, that is the best selling ice cream in India. So the aspirations in India are agnostic to the government. And therefore, the sectors such as auto, BFSI, consumption, energy ought to be bought, are basically to be bought by ignoring the noise such as, bad budget, failing, kind of, fading Namo wave and resurgence of Rahul Gandhi and so on and so forth. So to me, the recent fall in the stock exchange is being attributed to bad budget. Now let's try and see whether this is a bad budget altogether at all. See, frankly, this budget is not bad. It's not socialist. Frankly, if you look at the overall subsidy figures, these have just gone up in line with, the overall GDP, the national GDP. So the last budget before Narendra Modi goes into polls, he could have been far, far, far more populist. I mean, he could have robbed the riches and given money actually by, through helicopters, but he's not done that. But at the same time, I wouldn't say it's a great budget because kind of, it's directionless. Uh, the policies such as MSP revision, that is the crop price revision, healthcare, these are all political jumlas. I mean, everyone knows these are good to talk, but never going to happen in India sometime soon. What they've actually done is started to tax capital gains, which is to me a very bad in terms of timing, because the government kind of has to raise almost 80 odd thousand crores to meet through divestment by selling PSU stakes, and this they are trying to do at a time when the markets are not buoyant or the mood is very somber. And most importantly, they're carrying ahead the draconian tax policies. When, for example, when Congress left, the surcharge on income tax for an income above 1 crore was 10%. We had all thought that Modi will kind of, put an end to it. And this has just been increased by 300 bips over last, 3 to 4 years. So the salaried the middle class has kind of, got bruised. Having said that, so what should one do now? The cardinal rule of investment is a journey, at times a boring one. So know your cash flows, know your requirement, cut all the noise, cut all the emotions in the midway, and focus on secular growth sectors, focus on regular investments. Don't put money bulk at one go, put it in bits and pieces. And this is especially for the passive investors who don't deal in kind of direct stocks. Call for a financial planner. Drop me a line. I could kind of set up a meeting with our wealth guys who are based in London, or you could drop me a line directly in case you have a specific queries on certain stocks. More than happy to talk to you. So that was a brief presentation. More than happy to take any questions if you have.
Harsh, what do you think about the new taxation which they have come up? I've heard that about even NREs, if you are investing in long-term mutual funds, they are now taxing it to 10% of the actual gains. So, is it true? Is it going to be the case for equity fund as well?
Yes. So that is something that is what they have actually ended up hurting a lot of investors. That the capital gains arising out of buying and selling of mutual funds are now also subject to 10% tax. Essentially, that's this taxation, which was the long-term capital gains tax, did not exist until 2005 when it was abolished. It has been reintroduced now, and to that extent, the sentiments of a lot of these investors, especially the small and mid investors, that has taken for a beating. They should not have done that. And and frankly, it's just to give you perspective. So the government kind of came out with demonetization with an official reasoning that they want to formalize the investments, and that is the reason why a lot of money came into bank accounts and which got channelized into domestic mutual funds, and so much so that in last 1 year you have had almost 70,000 crores. That is the kind of inflow that domestic mutual funds have seen. So rather than encouraging this further, so that more people come to the more organized way of capital formation in economy, they are starting to tax it at a wrong time, and this may dissuade some people who kind of came to equities assuming that this is a tax free kind of instrument to invest. So I personally am quite disappointed that this should not have happened, but such is life. I mean, the investment risk does involve unfavorable regulatory policies, unfavorable government policies, so one has to live with that.
What is this 1010D actually? There is some kind of, uh, uh, I think, kind of a, they have some kind of a relaxation on this form 1010D kind of thing, where if you have some insurances which is 10 folds as that of your actual investment, then possibly you might get rid of that tax which they are talking about. Is it true?
So the ULIPs you may be referring to. So the taxation on ULIPs is ULIPs are not part of the 10% long-term capital gains tax. So that's become sort of a joke that if you frame policies haphazardly, you're kind of not taxing ULIP but taxing investments in mutual funds.
Okay.
Harsh, as San was mentioning about this capital gain tax, NRIs have got two types of accounts, right? As you know, NRO and NRE. I believe this capital gain tax will not apply to the people who invest in mutual funds through their NRE accounts, but will apply when they use their NRO accounts to make those investments. Is it my right understanding?
Well, to be very fair with you, I'm not fairly conversant with the foreign exchange laws and the taxation, which is kind of being talked for NRE and NR accounts. So you please allow me to drop your line with that. I'll definitely swing by.
Sure, sure, Harsh.
Thank you, Harsh.
And Harsh, one more thing, like people talk about market capitalization to GDP ratio in India is 101%, and hence it is not the right time to invest. And people, even analysts go to that extent where people say that, um, try to, make some kind of, sell off at this point of time, and later after a couple of months time enter into the market again. So there will be a correction that will take place in next couple of months time. So what's your thought process around that, Harsh?
See, one thing I've realized after being in stock market for last 15 years, it's extremely difficult to time the markets.
Yeah.
Uh, One can always predict, or rather one can analyze the bottom and top only when it has happened. And as a prudent investor, I don't look at markets. I look at individual stocks. And if there is a stock, as I said, which gives me a dividend yield of 5% and whose earnings are compounding at maybe 15% an annum, I'd rather buy that now, because for me, if I put my money into a bank account, I will make only 5% pre-tax. Whereas if I invest now into a stock which gives me 5% post-tax dividend yield, I'm still better off.
Hmm.
So I as a personal investor, don't look at index or Nifty as a barometer. I rather evaluate the individual stocks, and that's what I would urge you guys to focus upon. So this all is noise. That bad budget, Jaitley is not well, Jaitley is not doing well, etc. That's all noise. In this noise, if you're actively investing into stock markets, if you come across stocks in technology stocks, so for example Infosys, if it corrects maybe by 10% or so, it starts trading at maybe 12 13 times 1 year forward. Great company like Infi trading at 12 13 times 1 year forward, I think offers a reasonably good risk reward. So regardless of what happens to the global politics or Indian politics, the company does tend to do well. So point I'm trying to put forth is, unless you are looking to invest through mutual funds, uh, 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 you know, uh, you should focus on the individual stocks. And even if you are trying to invest through mutual funds, you need not do it in one go. Just stagger your investments. So, if, for example, if you were to invest £1 million, I'd urge you to stagger it in tranches of equal investment, equal tranches of maybe 12 tranches monthly, so that you can take advantage of time averaging. And I'm sure you all are quite learned and aware of these things. I'm just trying to reiterate that.
Thanks, Harsh. Harsh, one comment here. Uh, Harsh, one comment here, that whether the slide down of the market in India was after that budget, and the budget was not that great. If you have observed, the global market has crashed in the last 1 week. Look at Wall Street, look at FTSE 100, look at S&P, right? the whole world crashed in the last 1 week. Not a single day from Monday till Friday last week, the market was up. And if you look at the Wall Street, the whole week from Monday till Friday, it slided down about 700, 750 points. So I think in India as well, that it was an impact of that, not because it was a bad budget or a good budget, right? Just a comment.
No, you are right, and I will actually agree with you that the Indian stock market performance was confluence of too many things. One was, the local guys getting nervous and they selling down, but this also got coincided with the global events. And as you rightly said, there was a global turmoil and rub-off effect came into India. And to me, if my personal view is uh, this may continue for some time because the market valuations have really gone through the roof. I mean, last 5 years, this has been sort of a hope rally whereby there has not been any commensurate earnings growth, but the Nifty has more than grown by 2.5 times. Uh, so it's sort of a hope rally on Namo, hope rally on things will revive after GST, hope rally on interest rates will come down and so on and so forth. But now, if you have elections maybe a year down the line, this will be good time to take off some money if you are sitting on some profits, uh, and kind of wait for if you are active investor in stock. Unless you find a compelling risk reward situation, I would suggest that cash would be a better option.
Hmm. Hmm.
So I personally have not invested FII anything in last 6 months. I have not come across any mid cap or a large cap stock which fits into my criteria, which is doubling earnings in next 5 years and stock available at just about 10 to 11 time PE. So I look at almost 5 to 6 thousand stocks. I've not come across that kind of a stock which fits into that matrix. So I incrementally have not you know invested a lot of money in last maybe 6 months or so. Maybe only I would have booked money.
So Harsh, your organization even suggest about that, the global stocks as well, or only for that, the Indian stock?
So our wealth guys who are located in UK in London, they look at all the asset classes, and they also these are wealth managers. So
Okay.
for them, equity is one asset class among several. So they may also invest. They may also suggest you to invest in other currencies if there is an under appreciation or undervaluation in that asset class.
Okay.
So it's not restricted only to equities alone.
Okay. Thanks, Harsh.
All right,
Thank you, Harsh.
sure.
Harsh, just a very naive question again. In terms of as you said that you have to actually work on with your own stocks rather than actually getting into a certain mutual fund area if you really want to yield out some profit out of it or for better returns. So, I mean, say, like your organization, as you say, so you act as a financial consultant as well for anyone, individuals, or is it like only for, I'm say, what kind of uh, horizon you have in terms of your own company Wings expanded into?
So I think the wealth team out there looks mainly at two sections. One is the HNIs or high net worth individuals such as you guys, and the other is family offices of lot many corporates which are based in London or the European region. They end up consulting and doing financial plannings for them. So they do consult individual stroke offices across multiple currencies, across multiple offices, and so on and so forth. So if you're keen, I'll drop you an introductory email, and if you can just have a word with them, they'll be more than happy to talk to you.